This is Sovrun, your guide to financial literacy. Today, we're breaking down the single most watched number on Wall Street. Frontier Airlines just posted a loss, and the stock jumped 20% in a single day. How is that possible? Because what matters isn't the number itself, it's earnings per share. Earnings per share, or EPS, tells you how much profit a company made for every single share of stock. Think of it like a pizza. If a company earns $1 million and has 1 million slices, each slice gets $1 of profit. That's your EPS. Here's the formula. EPS equals net income minus preferred dividends divided by average outstanding shares. Let's run the numbers. A company earns $500 million. First, subtract $20 million in preferred dividends. That leaves $480 million available to common shareholders. Now divide by 200 million shares, and you get an EPS of $2.40. So what does EPS look like in the real world? The S&P 500 aggregate sits around $220. Apple comes in at $6.57. NVIDIA, $11.93. And Frontier Airlines, negative 46 cents. But that negative number still beat expectations. During the 2024 earnings season, Frontier Airlines faced soaring fuel costs and engine recalls. Wall Street expected a disaster, an EPS loss of 23 cents. When Frontier reported just a 17-cent loss, 6 cents better than feared, the stock surged 20% overnight. The beat changed everything. EPS is the E in the PE ratio, the most common way stocks are valued. But here's the trap. A higher EPS doesn't always mean a better company. They can inflate it through share buybacks. Always ask, is the business actually growing? EPS thinking shows up everywhere. Net operating income per unit in real estate, profit per partner in a law firm, even crop yield per acre. Follow Sovrun for more financial insights.